the discussion in this video will be the tax treatment of agricultural income. Now, before we move on to what is the tax treatment of agricultural income, let us understand what is agricultural income. Now, under the Income Tax Act, the definition of agricultural income is divided into three parts. Now, the first part basically deals with the rent or revenue which is derived from land which is situated in India and which is used for agricultural purposes. The second part of the definition deals with the income which is derived from such land which is used for agricultural operations. And the third part of this definition deals with the income which is derived from a building which is used for an agricultural purpose and is situated in the immediate vicinity of such land and is not situated in any specified limits. Now let's try and understand this definition in detail to see what is an agricultural income and what is not an agricultural income. Now if you see the first part of the definition, it says rent or revenue, which means that it not only includes the income that you get from your produce, agricultural produce, but it also includes the rent which is derived from the land. Which means if any person has rented the land for any agricultural operations, for an agricultural purpose, then such rent is also treated as an agricultural income. Now another point to be noted here is the rent or revenue has to be derived from land. That means if it includes any operations such as dairy, poultry farming, these are not directly derived from land, so they are not agricultural income. Thirdly is that the land should be situated within India. If it is outside India, even though you may derive any income from it, it will not be considered as agricultural income under the Income Tax Act. Such land in India doesn't necessarily have to be in the rural areas. It can be rural or urban. Thirdly is that the land has to be used for an agricultural purpose. So the first part of the definition clearly says it is supposed to be rent or revenue which is derived from land which is situated in India and used for an agricultural purpose. Now the second part of the definition deals with income which is derived from such land and which is used for your agricultural operations. So if you are directly involved in any agricultural operations, the kind of income you derive from that is treated as agricultural income under the Act. Now the third part, it deals with income which is derived from a building. When we say building, it's in the nature of like a farmhouse. So this building must be used for an agricultural purpose and this building should be situated in the immediate vicinity of such land. Such land as in the land which is situated in India and is being used for agricultural purpose. So if you have any land which is being used for any other purpose and this building is situated there, it cannot be considered as agricultural income. And such land such building should not be situated within any specified limit. So the Act specifies certain jurisdictions from the municipal municipal limits, which is considered as specified areas. And if such building is situated in such specified areas, then such income will not be considered as agricultural income. So in simple terms, when we say agricultural income, therefore it deals with your rent and revenue from land situated in India used for agricultural purpose. It also deals with income from agricultural operations, which is from the land. And thirdly, it deals with any income from building, maybe a farmhouse, which is situated in the vicinity of such land and is being used for agricultural purpose. So if you go by this definition, we can understand that let's say income from self-grown trees, any income from dairy or poultry farming, income from your mining and from any quarries, stone quarries, they will not be considered as agricultural income. Also another thing to note is if a partnership firm is engaged in agricultural operations and its main source of its income is agricultural income, then the partners of such firm also receive agricultural income. In the Income Tax Act, we say that the nature of income in the hands of the partnership firm is the same nature of income that is in the hands of the partner. Now, we understood that what is agricultural income. Now, the tax treatment of agricultural income. Under section 10 subsection 1 of the Income Tax Act, agricultural income is exempt from tax, which means it shall not be taxed. Now, so if you have any other income which is not agricultural income as per the definition, then it will be considered for tax computation as per the different heads of income, which we will study in the coming videos. Now, so if you see any dividend which is received from a company which is engaged in agricultural income is not going to be considered as agricultural income, because it's a company, and in a company you have a corporate wheel and it's separate legal entities. So the company is engaged in agricultural income, is engaged in agricultural operation and is receiving agricultural income, but the dividend from such company is not considered as agricultural income. And any interest which is levied on such land or payments related to such land or any produce, it's not considered as agricultural income. Interest is purely in the nature of financial income. But however, if there is any income which is derived from a nursery, which is nursery, it is considered as agricultural income as per an explanation to the definition to agricultural income given in the Act. So this is the definition of agricultural income. Now we know that agricultural income is exempt from tax. We will also have some cases where the income is not purely agricultural, which means there is going to be a portion of agricultural income and a portion of non-agricultural income. In such cases, the Act specifies, the rule to the Act specifies what a portion is considered as agricultural and what portion is considered as non-agricultural income. Now, this split between agriculture and non-agriculture depends on the type of operation. Now, if the person is engaged in cultivation of tea, in such cases, 60% of the income is treated as agricultural and 40% is treated as non-agricultural income. If he is engaged in rubber cultivation, then 65% is agricultural and 35% is non-agricultural income. Next comes in any coffee plantations. Now again, coffee is split into two. So if it's coffee which is grown and cured, then we treat 75% as agricultural income and 25% as non-agricultural income. However, if it is coffee which is grown, cured, grounded and roasted, in such cases 60% is treated as agricultural income and 40% is treated as non-agricultural income. Now, such a split is specifically given for these four. Apart from that, if there is any other cultivation, in such cases, we treat agricultural income as the total market price of the produce minus the cultivation cost. This way we can identify what portion is agricultural income and what portion is non-agricultural income. Now, as per the provisions of the Act, we have a case where we can take partial integration of the income, where a person has a portion as agricultural income and a portion as non-agricultural income. Now, what is the tax treatment in such a case? Now, in such a case, there are two criteria that have to be met to do partial integration of such income. Firstly is that the agricultural income should exceed 5,000. Secondly is that the non-agricultural income should exceed the basic exemption limit. Basic exemption limit as per your tax slabs. Now, once these two criteria are met, the computation of the taxable income is done through different steps. Now, how exactly do we compute the tax in such cases? Now, we first have to ensure that the criteria is met. Firstly, that agricultural income is above 5,000. Secondly, that non-agricultural income exceeds your basic exemption limit. After such criteria is met, you arrive at your agricultural income, which is going to be net of the costs related to your cultivation. Such agricultural income and non-agricultural income, you will take the total of it and compute the tax on it based on tax slabs. So the total tax on agricultural and non-agricultural income, you will arrive at a number which is going to be your step 1. After that, you will consider your step 2 is going to be the tax on your agricultural income and basic exemption limit. Now, why these two? So if you consider the step 1, you see there is agricultural income and non-agricultural income. We know that under section 10 subsection 1, agricultural income is exempt from tax. So we should not consider tax on it. Secondly, we know that there is a basic exemption limit for each person, for which there will be no tax computed. So the step 2, what we do is we calculate the tax on such agricultural income and basic exemption limit. So we've arrived at a tax on agricultural income and non-agricultural income. We've also arrived at the tax which is going to be applicable on your agricultural income and basic exemption limit. Our step 3 is going to be step 1 minus step 2. That means total tax on agriculture and non-agriculture minus total tax on agricultural and basic exemption limit. Now this total tax we're going to consider for our calculation of surcharge and cess. Once we add these two, we will arrive at the total tax liability. So this is how we will proceed with any question which involves partial integration, which is going to be a combination of your agricultural income and non-agricultural income. A detailed question on how we proceed with solving a problem on agricultural income with integration will be given in the notes below.